Hello and welcome to this session in which we will discuss the Foreign-Derived Intangible Income, FDII. What is the big idea of this Foreign-Derived Intangible Income? What's the purpose of it? The purpose is to promote, is to encourage companies to export. So what are you going to do? You're going to give companies some sort of an incentive, specifically financial incentive. So the Tax Cuts and Jobs Act introduced a deduction aimed at promoting, at encouraging U.S. corporation export activities. So what we do is we give a deduction to companies that engage in expanding international trade. We help them. How? We give them a deduction. What would a deduction do? A deduction would reduce your taxable income. It would reduce your taxes. So FDII essentially represent earnings from selling goods or services to non-U.S. entities for use outside the U.S. So you have to do what? You have to sell goods for someone outside the U.S. and it cannot be a U.S. entity. To do what? To encourage U.S. export. So in this session, we would look a little bit more in details about what does this foreign-derived intangible income entails. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, ForhatLectures.com.
Forhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
So what activities qualify under this FDII? Well, sale of goods. When a U.S. company sells product to buyers who are not U.S. residents and those products are intended for use abroad. So they are, goods, they cannot stay in the U.S. They cannot be used in the U.S. When a U.S. company provides service to a non-U.S. person in relation to property situated outside of the U.S. Again, the service provided doesn't have to be only goods, non-U.S. person, and outside the U.S. of A. This category also includes certain type of digital services. Transaction with related parties, with foreign related parties. Well, when a U.S. company sells a product to a related party that is not based in the U.S. And, remember, it's not only they sell it to the related party, and that related party in turn sells the product to unrelated non-U.S. entity for use outside the U.S. So you sell it to a related party, then that related party sells it to a non-related party. So as if you sold it yourself. What is the amount of the deduction? Now we know what activities. Well, for the tax year before 2026, you can deduct 37.5% of your FDII. And this percentage will decrease starting after 2026 to 21.875. Now it's important to note that this deduction is available for C as in Charlie Corporation. It does not apply to real estate investment trust. It does not apply to regulated investment companies. So you have to be a C corporation. So let's take a look at an example to see how this works in the real world. Let's assume we have a US-based C corporation, Tech Innovate, which manufacture advanced computer components. In 2023, the Tech Innovate sells $2 million to various non-U.S. entities for operation outside the U.S. Well, assume the $2 million is considered FDII, which it meets the qualification. If we take this amount times 37.5%, we have a deduction of $75,000. This deduction, what does it do? It lowers our taxable income, thus reducing our tax for the corporation. So if we're looking at 21%, you take $750,000 multiplied by 21%, and that will be the tax savings because we reduce our taxable income by $750,000. So it's a substantial amount. Simply put, almost 40% of your taxable income is wiped out. Let's take a look at this multiple choice questions from ForhatLectures.com. Which of the following does not qualify as a foreign-derived intangible income? Sale of a software to a U.S. person for use outside the U.S. Well, if they're using it outside the U.S., that's considered a form of export. Therefore, it qualify, therefore A is out. Services provided to a non-U.S. person located outside the U.S. Well, that's also services provided to a non-U.S. person located outside the U.S. That's FDII. We're looking for the one that's not. Sale of property to a non-U.S. person for use within the U.S. Well, the use is within the U.S. This does not qualify FDII. C could be a good answer. Let's look at D. Sale of property to a related party that subsequently sell the property to a non-U.S. person for use outside the U.S. That's also FDII qualify. So it looks like C is the correct answer. Sale of property to a non-U.S. person. So far so good. For use within the U.S., no good. So the answer is C as in Charlie. What should you do? Now you want to go to Farhat Lectures, look at additional multiple choice questions. That's going to help you prepare for the CPA exam, prepare for your accounting courses, invest in yourself. Good luck, study hard, and of course, stay safe.